Good morning, gentlemen. Welcome to another tremendous day of online learning. So we're going to be continuing with liquidity and measuring liquidity in a business. So following on from our previous lessons where we looked at the consequences of being illiquid being the inability of a business to cover and meet its current liabilities, we've been looking at working capital. Working capital is the difference between our current assets and our current liabilities. We obviously want and have discussed that this number be a positive value so that the value of our current assets exceeds our current liabilities so that we're able to cover what we owe to creditors within the coming year from the liquid assets of the business, the assets that we expect to turn into cash within 12 months, that being accounts receivable and the likes of cash along with inventory. Additional to working capital, we've got a couple of other liquidity measures that we're going to be looking at today. First and foremost, we're going to be looking at the current ratio. And the current ratio, as shown on the slide in front of you in this video, it provides an insight into the firm's ability to pay its current liabilities. So it's another measure of liquidity for a business. You can see from the calculation for the current ratio that it's worked out by simply dividing current assets by current liabilities and comparing this to a value of 1. So therefore, a ratio of 1 to 1 suggests that the current assets of the business are equal to the current liabilities of the business. Ideally, this ratio would be above 1.5 current assets to every 1 current liability. The higher the better, quite obviously. So the more current assets we have to current liabilities, the more liquid our business is and will ensure that we don't run into any of those difficulties that we covered in previous lessons, such as the risk of asset seizure or reputational loss to the business from being unable to cover current liabilities as they fall due. A ratio of less than 1 to 1 suggests that the business may struggle to cover their current liabilities as they fall due. We did make the point, though, that this is analysis of the balance sheet values, so the assets and liabilities of the business, and doesn't wholly account for the earning potential of the business. So it doesn't factor in that the business hopefully will be earning money over the coming period, so that if we did have a current ratio of less than 1 to 1, it still is possible that the business will meet its liabilities and will continue to operate by generating net profit from its sales in the current period, which would allow them to cover that shortfall between current assets and current liabilities. Now we have a activity there listed on our slide. Obviously this is one that we would be doing on the board in classroom, but if you'd like to quickly work that out, pause this video and then I'll tell you the answer. So to work out the answer to this question, we would be simply dividing our current assets, which are worth $100,000, by current liabilities, which is $80,000. So $100,000 divided by $80,000 compared to 1 would be generating 1.25 to 1. So 1.25 is worked out by dividing $100,000 by $80,000. As that value is greater than 1 to 1, we would say that the business has sufficient liquidity to meet its current liabilities as they fall due. However, this ratio of 1.25 to 1 is not massively above 1 to 1. So we would say that the business could improve its liquidity by building up its current assets. It might do this by holding more stock, more inventory, or building up the cash reserves in the business. Another analytical tool that we can use to work out liquidity of a business is the quick ratio. Now the quick ratio is similar to our current ratio, however, it doesn't account for the value of our inventory. So the quick ratio is worked out by taking current assets minus inventory divided by current liabilities and compared to a value of 1. So the only difference there is that we're not including the value of inventory in our current assets. Now, a key reason for this is that some businesses find themselves in a position where they are unable to make additional sales. There are a variety of reasons why this might occur. A very topical example would be a COVID lockdown. So some businesses have been forced to cease their operations, which would mean that they are holding inventory which they are unable to sell, but their current liabilities remain something that they're obligated to pay. So therefore, to cover their current liabilities, they would need to draw on liquidity or cash from their other current assets. Other reasons could be a small business that has few workers and key workers find themselves unable to work, perhaps through injury, other reasons for ill health, might even be absence for another reason. Or the government might come into a business and decide that it needs to cease operations for breaches in health and safety laws. So therefore, if a business finds itself in a position where it's unable to sell any further products, the value of its inventory doesn't reflect its liquidity, because it would not be able to turn that stock or inventory into cash. So that's a reason why the quick ratio doesn't include inventory, and we can consider this to be a more conservative measure. A more conservative measure, we can take this to mean that it's less optimistic about the business's ability to cover current liabilities. In terms of a healthy ratio, well, similar to our current ratio, anything greater than 1 to 1 does suggest that the business has liquidity and it's financially healthier. The higher that ratio is, above 1 to 1, the better for the business. As we've accepted that a current ratio of 1.5 to 2 to 1, 1.5/2 to 1 is ideal, we would expect that the quick ratio would still be healthy even if it was below 1.5, but it certainly has to be above 1 to 1. If our quick ratio is below 1 to 1, this suggests to us that the business might struggle to meet its current liabilities as they fall due. Therefore, the business might look to consider holding more cash and building up more cash within the business, so that in the event that it's unable to continue to operate, it could still meet its current liabilities as it falls due. And as we've learned in previous lessons, there are some very serious and unpleasant consequences for businesses if they fail to meet its current liabilities. In terms of our activities today, so we're not going to introduce any more content. We're going to look at the debt to equity ratio tomorrow, but it's time to start getting into exercise 2.1 of our workbooks. So you will need to open up our Part 3 Analysis and Interpretation workbook and access page 32. Your task is to complete the first 3 calculations of question 1, that being working out working capital, current ratio, and quick ratio. So if you can access 2.1 on page 32 and complete those calculations for part 1 only. We will look to complete the rest of 2.1 in tomorrow's lesson once we've introduced the debt to equity ratio. If you have any questions or concerns, please email me at t.horrocks@ags.school.nz. Well, all the best with today's work, guys, and I hope you and your families stay happy and healthy. Thanks.